Margaret retired at age 62 after spending 31 years teaching school in Ohio. She owned a traditional IRA valued at $240,000, along with a pension that handled her everyday expenses. Her financial advisor recommended leaving the IRA untouched. Allow it to continue growing. You will not require it for quite some time. So she followed that guidance. She stopped paying attention to it. Then she turned 73 and received a letter from the IRS. She now had to take out more than $9,000 from that account whether she needed the funds or not. That withdrawal, combined with her pension and her Social Security, moved her into a higher tax bracket. Her Medicare premiums increased. More of her Social Security became taxable. And her advisor, the person who advised her to leave it untouched, had never mentioned a 4-year window that opened in 2025 and closes permanently in 2028. A window that could have saved Margaret tens of thousands of dollars. She is watching it close. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Wazim, and this is Secure Future Hub. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through exactly what this window is, why it exists right now and not before, why it permanently closes at the end of 2028, and the 3 mistakes retirees are making right now that slam it shut before they ever get a chance to use it. Let me start with the foundation. Most retirees have heard of a Roth conversion. Very few understand why doing one right now in 2026 is different from any other moment in history. A Roth conversion is the process of moving money from a traditional IRA into a Roth IRA. When you do that, you pay income tax on the amount you convert in that year. In exchange, that money grows completely tax-free for the rest of your life. No taxes on the growth, no taxes on withdrawals, and a Roth IRA has no required minimum distributions. The IRS can never force you to take money out of it. When you leave money in a traditional IRA, the opposite is true. Every dollar in there will eventually be taxed. And starting at age 73, the IRS requires you to start withdrawing money whether you need it or not. Those are called required minimum distributions. A traditional IRA worth $240,000 at age 73 generates roughly $9,300 in forced withdrawals in the first year alone. That lands on top of your Social Security, your pension, your investment income, and the IRS taxes, all of it together. That is what happened to Margaret, and it is what is heading toward every retiree who has a traditional IRA and has not acted before 2028. Here is what makes this window different from anything that came before it. 2 things happened simultaneously that have never happened at the same time in history. The first is a new law. The One Big Beautiful Bill Act, signed on July 4, 2025, created a brand new deduction for Americans age 65 and older. It is called the Senior Bonus Deduction. If you are 65 or older, you can deduct an additional $6,000 from your taxable income. If you are married and both spouses are 65 or older, that doubles to $12,000. This is on top of your existing standard deduction. On top of the existing senior deduction, you can claim it whether you itemize or take the standard deduction. It does not matter. But here's the critical part. This deduction is available only for tax years 2025 through 2028. After that, it is gone. Congress has not extended it. It sunsets. The second thing is that the same law permanently locked in the current tax brackets. Before the One Big Beautiful Bill passed, those brackets were scheduled to revert to higher rates at the end of 2025. They did not revert. The rates you see today are now permanent law. This matters because when you convert IRA money to a Roth, you pay tax on the converted amount at your ordinary income rate in that year. Lower brackets mean you pay less to move that money to tax-free status permanently. Put those 2 things together, and you have something that has never existed before. A temporary deduction that reduces your taxable income sitting on top of historically moderate permanent tax brackets, creating a window to move IRA money into a Roth account at the lowest possible tax cost. And that window closes at the end of 2028. Let me show you what this looks like in real numbers. Take a married couple. Both are 66. Social Security income, a small pension, No wages. Their combined income before any IRA moves is around $80,000. In 2026, their standard deduction is $32,200. Their existing senior deduction for both spouses combined is $3,300. And now they have the new senior bonus deduction of $12,000 on top of that. That is $47,500 in combined deductions, shielding their income before they owe a single dollar in federal tax. If this couple moves $20,000 from their traditional IRA into a Roth right now, the senior bonus deduction absorbs much of that conversion. The tax cost of permanently removing $20,000 from the IRS's reach is dramatically lower than it would have been in 2024, more than it will be in 2029. Over the full 4-year window, a qualifying couple can move up to $48,000 into Roth status using this deduction alone. $48,000 that in any other 4-year period would have cost them thousands more in taxes. Now, let me show you 3 people who are handling this window 3 different ways. 2 of them are making costly mistakes. One of them is sitting in the single best tax position of her retirement and does not know it yet. Dorothy is 68 years old, retired postal worker from Georgia. She has a traditional IRA worth $175,000, Social Security, and a small pension. She has heard about Roth conversions, but every time she looks into them, she sees warnings about paying taxes and decides it is not worth the trouble. What Dorothy does not know is that at her income level, a carefully sized conversion this year would cost her very little in additional tax, and it would permanently remove that money from the reach of future required minimum distributions. Every year she waits, her IRA keeps growing. Every year it grows, the required minimum distributions at 73 get larger. At her current balance, those distributions will start at roughly $6,800 a year and increase from there as the account grows. That money will land on top of her pension and her Social Security and push her into a bracket she's never been in. And by the time those forced withdrawals start, Dorothy will have no choice. She takes every dollar out on the IRS schedule, not hers. Robert and Carol are both 64. They retired at 62 from a manufacturing company in Michigan. They are delaying Social Security until 70 to maximize their benefit. They have not started Medicare yet. Their only income right now is a small pension and some dividend income. Their combined modified adjusted gross income is under $60,000. This is the golden window inside the golden window. Their tax brackets are at the very bottom. No Medicare premiums are being affected yet. Almost none of their income is pushing Social Security toward taxation. And Carol turned 65 in December, which means the senior bonus deduction becomes available to hers starting this tax year. Robert and Carol should be converting as much as their thresholds allow right now. Instead, they are waiting. They do not know that this gap between retirement and Social Security, between low income and forced distributions, is the best tax moment of their entire retirement. James is 71, retired accountant from Texas. James knows about Roth conversions. He has been doing them. His mistake is the opposite of Dorothy and Robert and Carol. James converted too much in 2025. He pushed his modified adjusted gross income above $212,000 without fully accounting for Medicare's 2-year look-back period. The income from that conversion is now setting his Medicare Part B and Part D premiums for 2027. He did the right thing at the wrong amount, and he cannot undo it. Here's what Dorothy and Robert and Carol and James all have in common. None of them knew about the 3 traps that are built into this window, and if you convert without knowing where these lines are, you can end up paying more than if you had done nothing at all. Trap number 1, the senior bonus phase out. The new senior bonus deduction begins to shrink once your modified adjusted gross income crosses $75,000 for single filers or $150,000 for married couples filing jointly. For every dollar above that threshold, you lose 6 cents of the deduction. That means a Roth conversion that pushes your income past those numbers does not just add taxable income. It also starts eliminating the very deduction you were counting on to reduce the cost of the conversion. Your bracket says 22%. In the phase-out zone, your real effective rate is higher. You have to know exactly where your income lands before you move a single dollar. Trap number 2, the cliff. IRMA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge that applies when your modified adjusted gross income from 2 years prior crosses certain thresholds. In 2026, the first cliff is $109,000 for single filers and $218,000 for married couples filing jointly. Cross that line by $1 and your Medicare Part B and Part D premiums jump, not gradually in a cliff. And because Medicare looks back 2 years, a conversion you do today affects what you pay for Medicare in 2028. You cannot undo it after December 31st. Trap number 3, the Social Security torpedo. If you are already collecting Social Security, Roth conversion income counts toward your provisional income. That is the IRS formula that determines how much of your Social Security gets taxed. Below $25,000 for single filers and $32,000 for married couples, your Social Security is not taxed at all. Above $34,000 for singles and $44,000 for joint filers, up to 85% of your benefits can become taxable. A conversion that pushes you across that threshold does not just get taxed on its own. It triggers taxes on money you were already receiving. The real cost of that conversion is significantly higher than your bracket number suggests, and most retirees never see it coming until they open their tax return. Here's what I need you to understand about these 3 traps. They are not IRS tricks. They are mechanical rules that interact with each other in ways that are completely invisible unless you know to look for them. The danger is not the rules. The danger is treating a Roth conversion as a simple calculation, looking at your bracket, seeing 22%, and converting whatever fits. That is not how it works in 2026. Your actual effective rate on a conversion depends on what it does to your senior bonus, your Medicare premiums 2 years from now, and how much of your Social Security becomes taxable at the same time. The retirees who get this right convert the right amount each year for the remaining 3 years of this window, stay below all 3 thresholds, and get their IRA money into tax-free status before the senior bonus disappears. Those retirees can save tens of thousands of dollars in lifetime taxes. The retirees who do nothing lose the window entirely. The retirees who convert without knowing these interactions can end up worse off than if they had never converted at all. Both directions are costly, only one direction is right. Here is your action checklist. 7 steps starting this week. Step 1. Pull out your most recent tax return. Form 1040 or Form 1040 SR. Find your modified adjusted gross income on line 11. This is your starting number. It tells you exactly where you stand relative to all 3 thresholds before you convert anything. Step 2. Look up your future required minimum distributions. Go to irs.gov and search publication 590B. It contains the Uniform Lifetime Table. Find your age and your current IRA balance and calculate what the IRS will force you to withdraw at 73. That number is what you're trying to reduce right now before it is locked in. Step 3. Confirm you're claiming the senior bonus deduction. If you're 65 or older, it is $6,000. If both spouses are 65 or older, it is $12,000 combined. It is claimed on Schedule 1 attached to your Form 1040. Many retirees who already filed their 2025 return did not claim it because they did not know it existed. If that is you, speak with a tax professional about filing an amended return. Step 4. Before converting a single dollar, identify your 3 hard limits. Limit 1, the senior bonus phase-out, which starts at $75,000 for single filers and $150,000 for married couples. Limit 2, the IRA cliff at $109,000 for singles and $218,000 for married couples. Limit 3, the Social Security taxation threshold at $34,000 for singles and $44,000 for joint filers. Your conversion this year must stay below whichever limit you hit first. Step 5. Pay your conversion taxes from outside the IRA. This is one of the most expensive mistakes retirees make. If you convert $100,000 and withhold $22,000 from the IRA itself to cover the tax bill, only $78,000 enters the Roth. That $22,000 compounded inside the Roth over 20 years would have been worth far more than the conversion savings. Pay the taxes from savings or a taxable account. The full converted amount should be working inside the Roth from day one. Step 6. Work with a tax professional who has specifically updated their approach for the one big beautiful bill changes. Not every CPA or financial advisor has done this. Ask them directly about the senior bonus deduction interaction with IRMI and Social Security taxation. If they are not familiar with how those three rules interact in 2026, find someone who is. Step 7. Do not wait until December. Most retirees who do Roth conversions do them at year end. That is the worst time because you have the least data and the least room to adjust if something is off. The cleanest conversions happen mid-year when you have enough real income information to know exactly where your modified adjusted gross income stands before you move a dollar. Margaret is 73 now. She's taking the required minimum distributions she cannot avoid. She is paying the taxes she cannot escape. She's watching a 4-year window that she never knew about close behind her permanently. You are not Margaret yet. The window is still open. You have 2026, 2027, 2028, 3 tax years remaining. After that, the senior bonus deduction disappears. The extra room it created disappears with it. The cost of converting goes back up, and the IRS will still be there at 73, sending letters, requiring distributions, collecting taxes on every dollar you left, sitting in that traditional IRA. This is Secure Future Hub. If this video helped you understand something your financial advisor has not explained, hit the like button right now. Subscribe and turn on the bell so you never miss a video. And share this with someone who has a traditional IRA and does not know this window exists. They need to see this before 2028. Tell me in the comments, are you currently doing Roth conversions, or have you been waiting? I read every single one, and the most common situations become future videos.